we Filipinos still have a long way to go when it comes to investing for the future. We seem to prioritize.
Good morning, everyone. We appreciate you all for taking the time to join today's ATRAM market update. Every week, we continue to receive many questions from our webinar audience. We are very grateful for all of them. Since we are not able to answer all questions live, we normally post the unanswered questions on our website. However, from those questions, we have chosen a few that we would like to entertain this morning in our mailbag session. To help us answer these questions, we will be welcoming ATRAM's Chief Investment Officer, Mr. Phillip Hagedorn, ATRAM's Head of Macroeconomics and Sustainability Research, Mr. Jomar Lacson, and ATRAM's Head of Fixed Income, Mr. Miguel. However, before we begin, I'd like to remind everyone that you may ask questions throughout the discussion by clicking on the Q&A button on your screen. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section as well. As always, we will aim to leave a few minutes at the end of the discussion for your questions. Additionally, I'd like to let you know that this webinar will be recorded and that copies will be disseminated within the day, as well as posted on all our social media pages. Now let's kick things off with our Chief Investment Officer, Mr. Phillip Hagedorn.
Thank you, Santi, and welcome once again to our ATRAM webinars, our webinar series. It's really been a pleasure bringing this series to you all. I think over the last few weeks, we've really learned a lot. We had DG Limcauco of Ayala Corp here a couple of weeks ago, talking about how they're positioning themselves and getting ready for the return of normal work, hopefully. Last week, we talked about our balance fund, which has had a good week so far, actually. So really, first of all, hoping that you're all safe and healthy. I know it's been very difficult months, but we continue to move forward. Markets seem to be doing a little bit better, and today we're going to try and give you a picture as to where things are, where things may be headed, and really using the questions that you've asked, because many of you have sent questions that we couldn't get to right away, and we put them together today to try and give you a picture of where markets may be headed, particularly here in the Philippines, and how we approach that thinking, or how our thinking looks, trying to forecast where we're going to end the year this year. So we do have some slides, and I'll start, we can start with the first slide. Today I have with me also the head of our macro and sustainable research, Jomar Lacson, who's going to work with me through these slides and some of the questions that you guys have asked during our webinar series. No? So first question really revolves around the equities market. And there's a bunch of questions which, are asking primarily about recovery. Will we ever see 8,000 again on the index? What sectors we think will do best and will not do so good maybe over the next couple of years? Are there any new trends that we're looking at that will grow after this pandemic? And maybe some specific views on different industries in the Philippines and globally as well, and what we think the recovery curve might look for these industries in the coming months. No? So maybe let's start first with the PSEI. And if we show the first slide, the backbone of ATRAM research is fundamental research. And ultimately, it's about how companies will grow in terms of their earnings. All of us simply want to invest in companies that are growing their earnings and sharing their earnings with the shareholders, and also reinvesting, obviously, those earnings to continue to grow. And 2020 will prove to be probably the most difficult year in my 30 years of forecasting earnings. It's very, very difficult to understand where earnings of companies will be this year. But the idea is to try and understand where we've come from. So what companies were earning over the last couple of years, maybe 2018 and 19, and what those trends were, and maybe how quickly we can get back to that level. And that should give us a guide as to where markets will be and how quickly we can recover in the end of the day. So first, let's look at the PSEI or the PCOMP, the index members, no? As a group. We've looked at where their earnings are. And the way to look at this chart is the dark blue number, 10.3. That represents what the consensus earnings growth for the Philippine market was prior to the COVID pandemic beginning. So effectively, analysts felt Philippine companies were going to grow earnings by 10.3% before the COVID pandemic hit in 2020. Very quickly, that reversed. And a month ago, or a little bit more than a month ago, the analysts have downgraded earnings expectations from 10.3% growth to minus 7% growth for 2020. And more recently, after the first quarter numbers came out, further downgrades were made. And today, the forecast for earnings expectations for Philippine companies in the PSEI on average is 19% lower. So clearly, when you have a situation like this, stock markets will not perform very well. The flip side of that is, the sell-off happened very quickly. So the question is, how much of this downgrade is already priced into the market today? We'll try and answer that question. If you break this down to different sectors, it's interesting to see. I think you might be invested in a certain sector, a certain industry, and these are the numbers that are coming out. So using the same formula here, we have the consumer discretionary sector. So these are restaurants. And maybe just important to look at the last two bars per sector, no? Because the first two were the original forecast. The current forecast is earnings are going to be down significantly. They'll be lucky to break even this year. That's what many restaurants are looking at. And the actual number was only down about 3% in the first quarter, but we expect that to be significantly lower as we move on through the year. Consumer staples, on the other hand, have been very stable because these are food manufacturers that, people are still, thank God, eating 3 meals a day. In most cases, normal consumption patterns are still around. And so we've seen actually growth and are expecting growth of about 13.7% in earnings this year from this sector. The banks are still very difficult to gauge. The expectation is going to be negative growth or earnings growth this year, about minus 0.6%, where the actuals have been very flat so far. So it doesn't look like there's a lot of impact on the banks at the moment. Gaming sector clearly looking very weak. Tourism is going to be hit hard, and that's down 97% expectations. And and in the first quarter, we already saw them down about 38%. So earnings are very weak in that sector. The next slide shows you property, telecommunications, and utilities. The property sector is expected to be down around 20% in earnings this year. The first quarter was already at 20%. So I guess the outlook moving forward is some stability from then on. The telcos, on the other hand, very resilient. You know, data usage has been strong. Subscriptions have been strong. So we're seeing some positive earnings growth expectations on the telecommunications. On utilities, very weak. I mean, demand for power has been weak. So earnings have been very weak and are expected to be weak for the year. Next slide. Last three, the holding companies. I guess these are the large conglomerates, which make up a significant part of the index. About 42% of the index is made up of these holding firms. And they're expected to drop earnings by about 30% this year, while the first quarter was already down 26%. And in the industrial sector, again, there has been some growth expectations, but the first quarter has been proven to be very weak. Mining is a very small part of the index, so even if there's quite negative expectations there, it doesn't impact the index too significantly. But that holding firm number, that's what's going to be the drag. Now, the good news is that we do expect earnings growth in 2021. And the expectations of the consensus of analysts is around 25% earnings growth. So one thing we can look at is based on that number. So we're writing off this year and we're saying that maybe a lot of the bad news was in the price in March and April. What index levels would we possibly see should the market EPS growth next year approximate 25%? And the historical average of the Philippine Stock Exchange is just around the 18 times, 17 to 18 times. The recent lows, so from 2012 all the way to last year, we never dropped below 14 times. And that's actually where we're trading very close to today, based on expectations of earnings for 2020 and the growth that we expect for next year. We have a slight upside to about 6,500 for a base case of where we shouldn't be below, we feel, by next year. The worst case scenario is that things turn for the worst. That means that the health crisis becomes another crisis rather than a slow opening up. We have a second shutdown. And I think then we will retrace much lower to a lower PE multiple. And I would assume also that a lot of these EPS growth expectations would change if that were to be the case. Right now, we're putting a low probability for that happening. And we feel the base case is where we shouldn't be below 6,500. And the scenario of a best case of about 8,400 would have to mean that the economy continues to open up in a more normal fashion, and that by next year, we're back to more regular spending patterns and earning patterns already. So not quite a V, but a very steep U, I would call it, as a scenario. Plus, I think that would also mean that we would have to see some institutional investors, both foreign and local, a lot more active in the market as well. So those are kind of the three scenarios we have for where we think the index, or if the question was, can we get to 8,000 again? Absolutely, we can. The real question is the timing of it. Does it happen early next year or later next year or into 2022? I'm fairly confident that as a country, actually, we have the capability. Companies are well positioned, but we cannot allow the health risk to become a larger risk, and that's the big question mark on the table as we speak today. Next slide. So there was a question about industry trends, and maybe I'll throw this slide over to Jomar to help answer. Jomar, what do you think are some of the trends that might change or present themselves as opportunities because of this pandemic that we've gone through?
Yeah, thanks, Phil. So we do see three behavioral trends being generated by the pandemic. The first one is sort of a redesign of businesses to become more digital. Companies will have to surrender their analog processes and embrace more digital technology, which means more mobility, more productivity. And you can see that there's already happening with work from home and the development of technologies or processes that try to limit touch or contact through digital means like e-payments. The second one is about incorporating sustainability into your business model. Now, one of the sub-trends here is known as localization, which means like hiring workers that are within the community. So if there's another ECQ, it's not a big risk because we can still keep on working given that the workforce is still within the community itself, or offering products that are designed to the demands of the community. And there's also that third trend of a shift in consumer preference or prioritization. Now we can see these trends in the terms of, see that there's some development of home cooking skills and higher demand for health and wellness products or services, that should sort of enhance your ability to counter sickness or mitigate the need to go to hospitals.
Jomar, maybe based on these trends, what are the sectors that we think should do quite well at the time we're in versus those that might take a longer time to recover?
Okay. Guess on the next slide, we provide a list of sectors that might benefit from at least the medium term. Now, telcos are kind of obvious because there's going to be this need for data and video conferencing, but we also see that there could be a shift in capacity, particularly to the suburban areas, considering we have more work from home demand. The office space may also benefit because there's a view here that there's a need to maintain social distancing for work that cannot be done from home. Logistics and storage industry, should benefit from the need to replace capacity lost to commercial retail, but are gained by e-commerce, which will require e-payments and other fintech solutions to maintain security and digital connectivity. There's also manufacturing and agriculture. They'll continue to be there. Some of the consumer preferences will not change. And lastly, healthcare. As we kind of discussed, maybe less demand for gyms, but more on individual healthcare capacity. Now, the next slide gives us a list of those that we think are laggards. So the hotels, restaurants, transportation, ready for international, and some segments of real estate will be facing the challenges of the disruption, and they'll need to adapt if they're to be able to go back to that growth path.
Thanks, Jomar. Right. I guess there's. Can we go maybe to the next set of questions that have been asked? Well, I think we have with us Miguel Liboro. Miguel, are you online?
Hey, Phil. Yeah, thanks for having me.
Good morning, Miguel. Maybe you can help us out with some of these questions.
Sure.
You know, what will be the projection of Philippine bonds for this year? How long? Do you expected recovery given the current situation? Where do we think yields will be? And maybe some thoughts on a global recession. I guess another question maybe for later on is on the peso dollar. I mean, we're seeing the peso below 50 today for the first time in a while. So maybe after these three questions, we can tackle that one.
Sure. Okay, so first on the projection for Philippine bonds for the year, I'll take that, I guess, actually, I can take the returns on the second one. So from the start of the year, if you've been actually able to attend some of the webinars we were giving, even in, I think, March is when we started, right? We'd always look at 3.1% as our target, given everything we were looking at for the 10-year Philippine government securities bond, using that as a benchmark. We'd actually already gotten there. So at current market levels, we feel that yields are more or less fairly valued given how much the Banco Central has eased policy rates so far. Now, from current levels, we expect yields to move a little bit higher over the short term. But by year end, I do think we're still looking at a bit of a lower for longer type of situation, which is what you're seeing really all over the globe. You've got the Fed that cut rates to zero. You have the ECB and BOJ cutting more into negative territory, and central banks globally just continuing to do the same. The BSP has cut the policy rate to 2.75% from 4%. They've cut the reserve requirement rate from 14 to 12. And they're looking to cut that to 10% by the end of the year. So we do think that longer term yields will stay lower for longer. Now, what yields do we expect in fixed income this year? Our own strategies have delivered year to date a return of around 7% in absolute terms, which is in line with the broad index right now. Now, if rates kind of stay where they are, which is not our base assumption, if they just kind of stay where they are for the balance of the year, we think there's another 2 to 3% on the table. But if there are short-term opportunities that present themselves, we think we can get more than that. So I guess now for the final question, given the global recession, do we have a projection or outlook that government bonds might default? For the Philippines first, no, that's definitely not our base case. We're not going through anything that the rest of the world isn't going through as a result of COVID-19. We actually have a currency that is a which we'll get to later, I guess, outperformer against the dollar. And we continue to have healthy dollar reserves. Onshore liquidity continues to be strong. The BSP has continued to release that liquidity into the system. And we think demand for our local fixed income will continue to be strong, both in peso and dollar terms. Globally, corporate bonds, I think, are the area that may be a bit more negatively affected, with sovereigns to continue maintaining the liquidity and really maintaining that demand as the primary recipients of Fed and central bank largesse.
Thanks, Miguel. Just reading a question here. I'm not sure, I just want to read it off. It was just sent this morning. Why are bond yields not moving in tandem with lower benchmark rates? What's keeping the spread high?
Okay, sorry. Are we talking about corporate bonds then?
Bond yields, I guess.
Okay.
It's not specific in the question, but yeah.
Sure. Well, I'll address it as if, I guess, on the assumption that they're referring to corporate bonds.
Sure.
Well, the the bigger question, the answer is really that corporate liquidity in the corporate bond market is not as advanced as it is with our regional neighbors or the developed markets, and that's really why there isn't an active movement to track the spreads on your benchmark underlying government securities. That said, it's not necessarily true right now for corporate bonds on good names that everybody values on the 1 to 3 year or shorter portion of the yield curve. In that space, the spreads have been tracking and continue to be very tight, really because of the inherent risk in the current economic environment. People still want to hold shorter dated corporate debt. And they still want a bit of a spread over government securities. And that's why you still see a lot of activity in that space and a lot of demand in that space. Where I guess the question is coming from is on the longer dated corporate debt. And the reason that that's not tracking is, as I said, a function of the liquidity and also a function of the sentiment in the market right now that people don't want to be holding very long dated corporate debt when they're not sure whether or not those industries or those companies will be doing well over the next 3, 5, or 10 years.
And what about the last one on the dollar? Any thoughts on that today? I know it's very fresh, but
Sure.
what are your initial thoughts?
I guess what we've observed over the short term is really that the main mover on the dollar peso has been, more than any fundamental reason, the broad sentiment on the dollar, which when it's been risk off, rather when global markets have been selling off, you see the dollar appreciate locally. And that's because when people don't want to buy anything else, they tend to buy the dollar as a safe haven asset. So that's why you've seen these bouts of dollar appreciation. But as we've seen recently over the last, what is it now, Phil? Like, I guess the last week, global markets have been rallying despite everything that's happening in the world. And on the back of that risk-on sentiment, with people deploying into riskier asset classes once more, like global equities and commodities, you're seeing the demand for the safe havens, like the dollars, drop off. And as a result, the peso has been strengthening against it, which is why we've tested the 50 level today. I hope that answers it.
Yeah, no, and yeah, it seems like more of a dollar issue globally than anything else at this point. But are there any expectations of the BSP stepping in? I think they're probably going to let it test the 49 level for a while, no?
Well, the BSPs, yeah, it's an inflation targeting mandate. It's not part of their mandate to control the currency. They've definitely said in the past that they're willing to kind of let the market dictate it. And the flows right now look like they're not speculative, they're real flows. So I think, yeah, we might see a bit of volatility in the short term, but the BSP is willing to let the market.
I think inflation is going to come out tomorrow. It's looking like it's heading higher to the 2%, 2.2% level, but I mean, well below 3% still. So I guess nothing to worry about right now.
Longer term, I think inflation is going to kind of stay around here, but as we said in our previous webinars, we do think that the risk of a short-term uptick is definitely in the cards, especially as we reopen the economy.
Yeah, just got to watch that food sector, I think.
Yeah. Definitely.
Anyway, thanks, Miguel. Thanks for joining us this morning.
Thanks, Phil.
All right, do we have any more questions that we're taking still? Is there another slide here? I guess, let me see if there's some questions from the floor we can try to answer today. Jomar, maybe some thoughts on the OFWs and unemployment and the flows that we're expecting. Maybe you can share some thoughts there.
Yeah, for OFW remittances, there's some concern given that the data that we're seeing is more of the repatriation of OFWs. But there is this lag with respect to remittances, and the last data point still shows that there's still some growth. And our general view is, since more than 50% of the remittances are really coming from the US, then it should be generally stable the flows from the U.S. should be generally stable. Any concerns on the Middle East employment affecting remittances from that region, it's like the second bigger contributor to remittances, still has not been reflected into the data. So our general view is still that there's still some growth. With respect to employment, there is some concern that if ever we do have some recovery in terms of GDP growth, that we would still be seeing some unemployment in the economy. So it might be some sort of a jobless recovery. There's a view on that one, but it really remains to be driven, and the scenario is driven by the stimulus program of the government.
All right. Well, thanks, Jomar. I guess we just have a couple of more minutes here to go. There is a question about what's a good fund to invest in, UITF and fixed income. Is it a good time? I mean, last week, I think we talked about our balance fund, and we still think that is a great way to get exposure to the Philippine asset classes that we actually favor today over global. Both Philippine equities and Philippine fixed income, we feel have good outlook longer term. As a matter of fact, this fund has done very well since promoting it last week. It's up almost 6%, 5.8% as the stock market has moved. But as you know, it's a balanced fund, so only about half the assets are in equities and the other half is in fixed income. So that is one fund we have. Obviously, we have many more funds, but the most important aspect, I think, of investing in funds is to understand what your risk appetite is. And maybe I'll just take 2 or 3 minutes here to give you an insight as to how you can get that information from us. Try to understand what your risk appetite is. You can do this from home. So if I can invite Santi back online to maybe take us to the ATRAM website and show us just 2 quick tabs that help you hopefully understand your risk. Santi, can we do that?
Yeah, sure, Phil. 1 sec, let me share my screen here. Okay, so as a few of you know, we've launched our website maybe about a couple weeks ago. So it's very recent. But what this website has are specific tools and features for you guys to use, and specifically for risk, as mentioned. To go into our risk profile, go to the Funds tab. If you're looking at mutual funds, unit investment trust funds, either of those tabs work as well, but for argument's sake, let's use mutual funds. Right under the NAVs portion of the site is our risk profiler, which is an 8-question survey. There's no right or wrong answer. Takes about a minute to fill up, maybe less if you know the answers yourself already, and very quick. And what you'll get at the end of it is an estimate of your risk, right? And that's very important to know when looking at options for products to invest to. So once you have that risk, we can go back to the Funds tab and hit the selector tool, which is going to be one of the key features of our website today. And you'll see here on the right-hand side, risk profile. So these are all the risk profile options of all of our products.
You can plug in you press on your risk profile and you'll see funds that are available. So let's say I was a moderate, what happens?
Okay, for example, we have a moderate investor in the house. We click moderate, and then all our moderate products come up on the screen.
And you can look into the fund and find out data about it and stuff like that.
Yes, exactly. So let's say we're using the balance fund as an example. Let's click on the balance fund, and then you can go into their product page as well.
Cool. Thank you, Santi. No, I mean, that's thanks for that. Anyway, I've kept you guys over time by 4 minutes, so thank you all for sticking with us today. I hope that we've, again, enlightened you a little bit about what our thoughts are. I think the big question for me that people had out there, will we ever see 8,000 in the index again? My answer to that is yes. Just don't ask me when. I think it's likely that it might be next year, but if not, not long after that. I think this market will recover, and we're starting to see some of that happening. I just hope and pray that the health crisis continues to get under control, and we can continue focusing on opening up the economy and getting people back to work while being safe as well. So again, wish you all a great week ahead. Thank you for joining us, and we look forward to having you in our future webinars in the coming weeks. So thank you very much again, and have a good day.
Okay, thank you to Phil, Jomar, and Miguel for your very impactful insights, and to our audience for all your questions. Before we wrap up, I'd like to remind everyone that a recording of this webinar will be released to all of you, as well as posted on all our social media pages shortly. We also would welcome all of you to visit our website at www.atram.com.ph for more information. As we end this webinar, we will be sending out a short survey to get your valuable feedback to ensure we keep making these updates relevant and useful. We hope you can spend a couple minutes to answer the survey. We appreciate you taking the time to join us, and on behalf of ATRAM, I would like to wish you all the best of luck. Please stay safe and have a great afternoon.